All right, well, we'll jump in. We have a few other people I think that are going to be joining us. So, um, we are very Tracy and I are very thankful. So, I've known Brandon for I don't know a while, 6, 7, 8 years, some I don't know, a while.
Pre-COVID, so that's like before the beginning of time for everyone,
Yeah,
right?
right.
Yeah, yeah.
Very much so. But Brandon is from Milwaukee, Wisconsin, and just an absolute awesome individual, but super insightful, especially when it comes to 1031 exchanges. He's got a plethora of knowledge, and so he was grateful enough to give us his time today and a lot of his insight. And so, kind of how we're going to run today is we will keep everybody on mute. If you guys do have questions throughout the masterclass, Brandon's probably going to talk for about 40, 45 minutes. But if you guys have questions, go ahead and throw them in the chat. And then we'll also do a Q&A at the end. But if you have questions, feel free to throw them in there. And yeah, so I'm going to turn it over to Brandon. Again, Brandon, thank you for giving us your time and your knowledge here. So I'll pass it over to you and we can rock and roll.
Awesome. Thanks so much, Drew, and thank you everyone for spending the time. I can tell we've got a lot of good energy here already, which is always fun. I'm going to share my screen, so I have a bit of a deck. It won't be too painful as I walk through it. And yes, I please ask questions. Um, this will get very boring if I'm talking for 45 minutes, and it'll get boring for all of you. And I'm not singing, so I might make Drew sing though. Like if we get too bored. We might have to have you bust something out, Drew. So like, get ready. Get ready to do that a little bit. All right, here's a disclaimer. I'm not a CPA. This is not legal advice. This is informational only. Did everyone read that? Someone nod their head and say yes. Good. Awesome. I've done my compliance work for the day. Here's what we're going to walk through. So I'm going to take you through the 1031 exchange from front to back. And I'm going to tell you everything that you need to know, just enough so that you don't get in trouble, that you can complete the exchange properly, and then strategically how you want to sort of use it, right? There's another 3 hours of detail on 1031 exchange, which, if you're a complete nerd like I am, is really interesting, but it's not really useful, right? So I want to hit the salient points that are useful that you can walk away from here and go, okay, I know what to do if I need to do a 1031 exchange tomorrow. I know the value that I'm going to get out of it. I know when to use it. So if we can answer all those questions, great. Then I'm going to take you through a little bit more of a complicated concept. And what I spend most of my time doing is taking people from active real estate investors to passive real estate investors. All of you look way too young for that. And that's okay. But I wanted to make you aware that this strategy is sort of out there. And it's something that, I've talked to a lot of people who get a little bit frustrated about the aspects of active management and want a little more passivity. In addition to that, I'll go through some more advanced solutions that would actually let you 1031 exchange and think about some of the offerings that Drew is contemplating. So there's a way to do that. And so I'll take you through that at the end too, which we think is a really exciting concept that we're really pursuing and going first with our clients. So that's what we'll do today. There's me with the full beard many years ago. So who am I first off, right? So my name is Brandon Bruckman. I am an investment advisor by registration and trait, which is such a weird thing to be and to talk about real estate. Like, what am I doing here, right? We spend the vast majority of our time, as I said, working with real estate investors that are seeking to retire, want out of this business, they want passivity, they don't want to pay taxes, right? And that sounds like all of us, right? The tax bill that those folks would have to pay is usually 30, 40% of their capital. You worked for 30 years to get that. I don't think you want to give it away, right? So that's what we'll spend a lot of our time doing. We really act as a go-between and really quarterbacking the 1031 exchange and then thinking about the investments on the backside. That's where I spend most of my time, is working directly with clients and doing and leading our due diligence efforts within our firm. So myself and my partner started this shop about 8 years ago, and we've been involved in the DST 1031 exchange side for the last 6 years, and really spent just a ton of time figuring this thing out. So that's about me. Enough about me. Let's get into the content, right? The 1031 exchange. Really simply, here it is at the highest of highest levels of things that you need to do. Okay. So when we do a 1031 exchange, the number one mistake that I see people make, and there's no way to correct this, is not using what's called a qualified intermediary. This is a very important term. So when you look to sell your property, you absolutely can't call me up and say, "Hey, Brandon, I sold my property. I really want to do all these advanced cool things you talked about in this webinar. I got this check in my hand. Let's get rolling." Sorry, you've already screwed it up. Unfortunately, like as soon as you're holding that check in your hand from the sale of your property, you cannot do a 1031 exchange and you absolutely have to pay the tax. There's no going back. So it's absolutely critical when you're thinking about selling your property, you want to do an exchange, that you talk to the broker that you're working with, the title company, anyone who's involved with that transaction that's supporting you, and you say, "Hey, before we close, I want to do a 1031 exchange." And it's very easy for you to find a qualified intermediary. Most title companies offer that service to do a 1031 exchange. It's very simple to get set up and structured with that. All you got to do is ask for it. If you can't do that, we'll provide some resources post call of some national qualified intermediary firms to be happy to work with your title company and solve that for you. But this is the number one mistake that I see. And unfortunately, I'd say every month someone calls me and says exactly the phrase that I walk through there. And I have to be the person to tell them that they probably have a 40% tax bill. Not a fun day for me, really bad day for them, right? So let's make sure that number one, you have this qualified intermediary in place. Number two, biggest mistake that we see too, is there is a timeline to complete your 1031 exchange. This is in the code, it's by law. The 1031 is part of the tax code. That is the number of the tax code. It is in there. And this is in there too. And so you have two important deadlines to think about from a timeline perspective. One is the 45-day mark from when you close. The other is 180 days from when you close. At that 45-day mark, you absolutely have to send some sort of form, and your qualified intermediary will help you with this, that indicates the kind of properties that you want to identify. And we'll go through identification rules here in a couple slides. But you absolutely have to do that at the 45-day mark. Unlike our taxes that we file, there is no extension timeline on this. There is no wiggle room. There is no gray area. If you do not hit that 45-day mark and submit, you owe taxes, period. All right, so that's a key point. And then 180 days, you absolutely have to close on those properties that you identified. If you don't do that, you owe tax. No extension, no exception. That's our biggest mistake we make. Some of the, I'd say, misconceptions that we have about the 1031 exchange is, "Hey, I got a single family property that, I'm managing right now. I really want to trade up. Like I've earned a lot of equity. I'm going to bring some more equity. I want to buy this multifamily building. Can I do that in exchange?" Absolutely. Real estate's real estate. The key is that it has to be investment real estate. So what does that mean? That means that you have to intend to hold that property for investment purposes. So what may be going through your head right now is, "Hey, I just did a flip. Can I do a flip in a 1031 exchange?" No, because you didn't intend to hold that for investment purposes. You intend to operate a business to flip that property over and make profit. That is not for investment purposes. Now, are there games that you can play there a little bit? Here comes a gray area. Are there some games that you can play there a little bit with your CPA? Absolutely. You'd want to consult your CPA on that because it is intent and it's hard to prove intent, right? But if you run a business where you're constantly flipping and all of a sudden you want to do a 1031 exchange, that's going to be pretty tough. So you have to really establish a fact pattern to do that. So intent, you have to hold for investment purposes, but real estate is real estate. We have a lot of investors that they're farmers. They own farm real estate and they want to transition into commercial. You can totally do that. You can totally do that. So there's a lot of flexibility there. The most important thing that we talk to folks about is this timeline is tight and there's a lot of moving pieces. And so unfortunately, you have to give a lot of effort to this transaction because you have to think not only about selling your property, which is enough work already. We all know that. You have to start thinking about what you're going to buy next. And you got to do this congruently. And so that's going to require a lot of your time. But you really want to have a plan going into this. Best clients that we talk to call me way before they've thought about selling. They don't have a property on the market. They're not there yet. They want to build a plan. And so I usually hear from them at least 2 to 3 months before they actually intend to pull the trigger. That's a good call for me. I like that call a lot better than the call where I sold my property and I didn't do the QI thing. Much, much better. Ultimately, at the end of the day, your rule keeper in all of this is not me. It's not your qualified intermediary. It's not your title company. It's your CPA. You absolutely have to get your CPA involved in this transaction. There has been too many clients that we've talked to where they don't actually have the same kind of tax consequence that I've bemoaned about, this 30, 40%. They actually don't have that. There's other things in their tax life that actually helps them offset that. And so sometimes our clients will look at it and go, wait a second, tax bill is not that bad. I'm not that adverse to paying it. And I'd like the liquidity and access to the capital. So they shouldn't actually do a 1031 exchange. That's the conversation we want to have before we do almost anything here, is check with your CPA and just ask the question. If I sold this property I'm thinking about selling, what do you think my tax bill would look like? Then you can start to do this process. I should put this at the front. This is the one that we really want to start with, is really talking to your CPA. So that's really at a high level. Here's how you stay out of trouble in the 1031 exchange transaction. And here's the things that strategically you sort of need to do. Let me go to some more of the details. Ooh, questions. This is a great spot for questions. Tracy, do you have one?
Yeah, I just want you to go over who would be a qualified intermediary. Can you give examples?
Ah, sure. So there's a lot of different folks that can be a qualified intermediary. There's different things that you want to look for. So they cannot be an associated person. So if like there's a lot of lawyers that will do this work, if they're your lawyer, they can't be your qualified intermediaries. They can't be associated with you, right? So most of the people we see do this are title companies. Like on a national level, we'll see firms like, and you can look these up, IPX, Exeter. Those companies will do this at a national level. But if you look locally and talk to your title company, they probably do it, right? So here in Wisconsin, and I don't know where everyone is from on the call. I think we're all over the place, right, Drew? Everywhere? Okay.
Yeah,
Good.
everybody's, I think we're all from all over I'm currently in Wisconsin, but everybody's kind of all over. So,
Oh, okay, sure. Yeah, so I mean, at a local level, we have three or four that we use um, pretty consistently, and they're all the leading title companies. They have a 1031 exchange portion inside of there, so that's always the place to start. I think is with the title company, because it's the easiest thing to do. They already have your transactions there; they understand it. So if you have somebody who's competent there on the 1031 exchange side, just use those folks.
So, what if it's a title company that you've used a whole bunch of times? Does that count as somebody that you're already associated with?
No, not in that context,
Okay,
because you're using them in that real estate transaction. So it's more of that
perfect.
outside services where that comes into play. No concern if you've used that title company before.
Perfect. Thank you.
Yep. Other questions here. This is a great like stop point to really ask some questions. I see
so
some.
Bonnie,
I see some in the chat, Drew. You want to pull some of those out? We can do that right
yeah,
now.
so, well, yeah, first everybody was just typing in where they're from. So we have
Oh,
all the
I
way
see.
Florida, California,
Oh wow,
Virginia,
awesome.
Alabama. Tracy's in Utah, Wisconsin. Like we're all over the country, which is awesome.
That's great.
So Bonnie just asked, oh, New Mexico. Bonnie just asked, how do you handle a purchase in another state?
Yeah, no concerns across state lines at all. So if you're, again, it depends on, I would say give the exact same advice. So if you have a title company in Florida that's utilizing that transaction, and they have a 1031 exchange arm, great, go ahead and use them. I'll watch often with our clients. We have a lot of clients in California and they have out of state properties. They'll use a national qualified intermediary to kind of sit on top of that and be that. So we have a client that has properties in Oregon, Michigan, and Florida and they're using national QI company to kind of just keep this in order, right? Because the title company on each one of those is going to be different on the sale. So they'll use a national company. I'd probably advise folks to do that just to have some congruency in the transactions.
Perfect. And then to follow up to that, Bonnie just said, so you use an intermediary in the state where you're purchasing?
Don't have to. Don't have to. Not a requirement. So there's really no locational requirements to the use of a qualified intermediary. They can be from anywhere. Good questions. Good questions. All right, so we talked a little bit about the timeline. Let's talk about it in a little bit more detail. We talked about the QI. Again, you can't take possession of the funds. QI will hold that for you. You'll actually see that on the settlement statement. It'll say with QI qualified intermediary company in lieu of Brandon Bruckman LLC. It'll say that on the closing statement about where those funds are going. It's absolutely key. We need that on there. Then with 45 days start. The identification rules, there's three of them. I'll go slow on these because they're kind of complicated. The first one's very easy. So it's called the three property rule. When you identify, you can identify one, two, three properties. When you identify those properties, they have to be specific. It can't be, some property in Milwaukee. No, no, no. It has to have an address on it. Very specific. So you can identify three. You can close on any number of those properties that you want. That's the most commonly used rule that we see. The second rule says, let's say that, you have a pretty large transaction and you want more than three properties. How do I do that? Well, you can use what's called the 200% rule. The 200% rule says I can identify any amount of properties I want, up to 200% of the fair market value of what I sold. So we'll use that a lot when we're talking about some of these advanced strategies because folks want to identify more properties. You can do that all day long, as many properties as you want. Third rule rarely gets used and says I can identify any property that I want, but I have to close on 95% of that market value. We rarely ever see that used. Don't know why that's a rule because no one uses it. It's really the first two that get the most usage. But we have to be very specific about what we're identifying. That's the key thing there. We cannot be general about it. Hence why I said we got to run these processes congruently of selling and buying, because we really got to figure out what to buy, and we got to figure out how to do it fast. Then, of course, at the 180-day mark, we would close. We can close before that. We can close before the 45 days if we wanted to. If we really have our act together, we could sell and close simultaneously. That was the first ever 1031 exchange transaction. It was a simultaneous sell and buy. So you can do that. But we have this timeline. We don't have to adhere to it. Those are the standards. So that's timeline in more detail. What's next? The like kind requirement. We talked about this a little bit, so I want to go into more detail about what it means. So what is like kind? So that's what you can do in the transaction. Real estate is real estate. So I can exchange any of these things as we talked about, a single family for multifamily, a commercial office for a single family, industrial for multifamily. I can exchange all these things for each other. This is completely fine. Here's the stuff I can't not exchange, right? So folks will ask us very often, a lot of the questions we get around partnership interest in, say, a syndication or mutual funds or REITs. Like, hey, hang on, REITs are real estate holdings. Why can't I 1031 exchange into that? Because you actually don't own the real estate in the eyes of the IRS. You just own equity in the REIT. You don't own the real estate. Same thing in a syndication. You're like, wait, the syndication's an apartment building. That's real estate. No, you're a limited partner. You own a partnership, not the real estate in the eyes of the IRS. So it's very important that this is a very broad list and we're able to do a lot of things here, but there are some things we can't do in the 1031 exchange transaction. A lot of that has changed recently. You used to be able to 1031 exchange personal assets up until 2016. Can't do that anymore. So we're just stuck with real estate to do, but we still have a lot of flexibility.
So Brandon, before we
Yeah.
jump to the next slide, I'm interested in the when it's oil and gas interest, right? So there also is syndications out there for oil and gas interest. Now, is this the land or is this because does that fall under the same situation like you were saying as a syndication, as a limited
Yeah,
partner, or is it all how it's structured?
it's the latter. It's how it's structured. So we see some of these deals structured as funds. That won't work. We see some of these deals structured where you're owning a partnership. That won't work. Where you actually own the land and can take title of the land, that works. So
Got it.
that you can do. You just can't do the other pieces. So you have to be very careful about what's eligible there. We watch most people that are doing that go after mineral rights, mineral interest. It's much clearer that they own the land and what they own. I mean, there's like coordinates on those closing statements about what you own. So
Got it.
that one's a little bit more clear. It gets a bit more ambiguous when we talk about just having oil and gas interest. It has to be set up and designed and structured in a certain way.
Got it. Okay. And then Bonnie said, so if we are the sole member on a property we're selling, we cannot purchase a property with a husband or partner, correct?
Yeah, you have to maintain. I have a slide on that. We'll talk about it now. So you have to maintain the same entity and interest from one to the other. So if you're purchasing that as a sole member, you have to buy the next property as a sole member as well. This gets a little bit trickier when you have a trust involved or an LLC. There are maneuvers that you can make there to change that interest. So, for example, I have a client that purchased a lot of DSTs or a lot of replacement properties as a sole individual, and now wants to transfer those into a revocable trust. You can do that. You can do that post closing. You can do that at closing if you wanted to, right? Because it's a pass through entity from a tax perspective and it still points back to you. So you can do that. What you can do before you close, if you want to get really complicated, is let's say it's the other situation for you, Bonnie, where like you're ready to own that property with a partner, and maybe you don't want to do that anymore. So what you can do before sale, and you want to consult the CPA on this, but before sale, you can do what's called a swap and drop. So you can actually change the ownership of that structure, depending on what state you're in, turn that structure into a tenant in common agreement where you own 50-50, you own half that property, that partner owns the other half. And then you both can do a 1031 exchange and go your separate ways. So that you can do. Right? That's a little trickier, involves a CPA. But I think the scenario that you're talking about where you bring in a partner, that would be problematic in the 1031 exchange transaction. Good questions. Really good question. I've bemoaned this point before about timelines. I'll do it again because it's just so important. When you're not organized, people miss these deadlines. And so just please to God, have a plan and think about that beforehand before you get started. There are no exceptions. We see occasional exceptions for natural disasters. When hurricanes flow through Florida, we will watch the government actually extend some of these deadlines. That's the only time we see it. The wildfires in California, we actually saw a 1031 exchange extension. Other than that, 45 and 180, and that is it. We talked about these a little bit. Here's a visual representation of that, so you can kind of see it on a slide of what the identification rules are. So again, 3 property rule can close on any combination of 3 properties with addresses. 200% up to double that fair market value of what you sold. Again, identify as many properties as you want, close on what you want there too. And then again, the 95% rule has to be very specific. But again, you can ID any number of properties. Again, here it is in a sort of visual representation, so you can kind of see it. These are things that a good qualified intermediary will walk you through in extreme detail about how to do this and execute this properly. That's why we need them on board, is to sort of help us record the transaction and wire money. Those are their only functions in this transaction, but they bring so much knowledge about how to do this and structure and do it correctly. So they will help you with this. We'll help our clients with this, obviously. Oh, yes. Get this question a lot of, all right, I sold my property. I have a $50,000 gain. I'm going to invest that gain into the next property. Well, wait a second. No, you're not. In order for you to get the full tax deferral, what you need to do is to do 2 things. One, all those proceeds that are sitting with your qualified intermediary, you have to reinvest them in real estate, in investment real estate. That's 1. And 2, you have to purchase a property or properties that are of equal value or greater than the property that you sold. If you do those 2 things, you'll have full tax deferral. If you don't do those 2 things, you'll create what's called boot, and you'll have some level of tax associated with your transaction. And so this gets really, really tricky if you have a mortgage on your property. It's a hard one for folks to understand. Like, wait. I paid the mortgage off when I sold the property. Why do I need to get another mortgage? Why do I need debt? It's because you're not sufficing the second portion of what I described. Without the debt, how are you going to buy a property that's of equal value or greater than what you sold? You probably can't. So you need to replace the debt in that next transaction or bring more cash to the table so you can buy something of equal or greater value. The entire purpose of the 1031 exchange and why it's part of the tax law is for you to keep investing in real estate. The tax law benefits 2 people. The entire tax law, the giant, huge book, 2 people get benefited from it. Those that invest in real estate, those that own and operate businesses. The tax law is built for those folks. They want you to reinvest in real estate to drive economic development in this country. That's the whole point. So whenever you take cash out of the transaction, or don't buy something of equal or greater value, the government says, hey, you recognize some economic gain in that. We want to get paid, right? We want you to reinvest. That's the incentive. So this is very, very important for folks to kind of wrap their brain around. And it's a tough one too, right? Um, Getting more debt right now is hard. It's expensive. It's probably more expensive than what you're selling, the debt on it. This makes it a little difficult, but it's a must if you want full tax deferral. Kate has an interesting question. So theoretically, could you take a loan against a property you already own and then, more questions. I was reading your question and it disappeared. You theoretically take a loan against a property you already own and put it towards that, or does it have to be a new purchase? Um, I think that's a good, let's talk about that strategy in a bit more detail. If you're pulling a loan against your property, say the back end of like a BRRRR strategy, I wouldn't do an exchange there per se. I would use that to continue to build your real estate and your wealth that way, and then probably hold those properties and pay those mortgages down. But if you did do that, like if you had no debt on a property and you pulled, 80% LTV loan out on that, you left 20% equity there. If you went to sell, yeah, you'd have to replace that 80% of debt. You would have to do that. So I think when you're pursuing a strategy like that, it's important for you to hold, pay those mortgages down, and get them into a place that's more reasonable for you to sell and do the exchange. So I hope that helps in terms of an answer.
And then
So it'd be
Brandon
better to
Bonnie had,
yeah, I want to do Bonnie's too. So it'd be better to refi cash out in the first property. Yeah, probably. The answer to Bonnie's question would be yeah. If you're looking to build your wealth, you want to hold that property and it's cash flowing, has good metrics and numbers, and can cover that debt that you want to put on it. Yeah, absolutely. Refi it, take it out, buy more property. The inherent risk in that from a real estate perspective is always leverage, right? So, can you service and perform on the loan properly? The answer is yes. Then yeah, by all means, continue to leverage and buy more real estate. But that's sort of the question. And then the question ultimately becomes, do you want to sell it all, right? I mean, you don't have to. If it's cash flowing property and you like managing that thing and it's appreciating for you, like keep doing that. Don't stop. But at some point you'll find some reasons to sell. And that's where these strategies become useful. But if there's no reason to sell, don't do that. Hang on to it. Good questions too. Really good. Okay. 2 out of every 5 closing statements that I look at in a 1031 exchange transaction has some sort of error on it that's creating tax liability. Say that again. 2 out of every 5 closing statements that we look at has some sort of error on it that's creating tax liability. So there's 2 expenses and types of expenses, and I'll lay them out in detail of what's permissible expenses in a 1031 exchange transaction and what's a non-permissible expense. The easiest way to think about it is this. A permissible expense in a 1031 exchange transaction is anything associated with the sale of that property. Broker's commissions, paying the title company, paying your qualified intermediary for their services. Anything associated with the sale of the property in the transaction is permissible. Anything that's not associated with the sale of the transaction, like property taxes, prorated rent, security deposits, those are non-permissible selling expenses. You've actually created boot when you do that. The way the IRS looks at that is you're using proceeds from the sale to back reimburse the buyer for some of those transactions. They don't like that. So, I mean, you're going to create some tax liability there in doing that. It's probably going to be really small. Most of our clients ignore it. Others, it's bigger and they get concerned about it. I'll give you an example. We had a client pay off a loan early, and they actually had a prepayment penalty associated with that loan. The prepayment penalty was $500K. They're like, that's a problem because that's going to be taxable in the transaction. So what they did is they did us on the bottom. They actually reimbursed the 1031 exchange account for that amount. You can do that. So you can wire extra funds to the qualified intermediary post closing to backfill some of these expenses that are non-permissible to really produce a zero tax liability. Again, that's a good conversation to have with your CPA about whatever liability that you may have, but there will be some if you have non-permissible selling expenses on your closing statement. Most people do. Most people have prorated rents and such on closing statements. Happens all the time. Here is a, oh, we don't have the full list. I missed that slide. But this is what to really think about is what is that tax liability? Can you restructure the purchase so some of those items are worked into the purchase price? That's an option too. So that's something you may want to think about post closing as well is, hey, can I adjust the sales price for some of those prorated rents and tax liabilities, etc.? Do that. That's the best way to go about this to make it the cleanest from a 1031 exchange perspective. But it's so rare for folks to do that. So again, something to just watch out for when you're doing the exchange. You may produce some tax liability. There's ways and things you can do about it. I think, yeah, that is the end of the 1031 exchange portion. I'm gonna stop. I want to stop here. And what burning 1031 exchange questions did I not answer that are top of people's minds? Drew, have you done a 1031?
Have I? No. No, I've not. If I did, you would have been the person I called. So.
That's a good point. That's a very good point. How many people on the how many great point. How many people on the call have done one? Have actually done a 1031? Kate has, awesome.
I think
Saved me thousands, Kate said, yeah.
Bonnie, my husband, did
Bonnie,
last
your
year.
husband did one
Awesome.
last year. Awesome. Susan's done it too, great. Are some of these things ringing true that I'm talking about for those that have done these transactions? Is there anything you saw in the transactions but was sort of problematic? Any stories? Any horror stories? What you guys think about that one? I'm gonna keep rolling through. But great questions.
Susan had a quick question. She said,
Yeah.
can you share about handling improvement costs during a 1031?"
Yeah. So if the next property you're buying is a property that you want to do improvements on, this gets really tricky. So what you have to do is um by the end of that time frame, by the end of that 180 days, you have to have an appraisal on that next property that meets the guidelines that we've talked about in order for you to get full tax deferral, right? So you need an appraisal at the end of the 180-day timeline that indicates that that property is worth the same or more than the property you relinquished to get full tax deferral. So the qualified intermediary will work with you on releasing funds from your account in order for you to pay for those construction improvements. But the timeline is problematic. It makes it very, very hard to do these transactions. We see them, they happen. But if you thought it took a lot of planning to just do a sell and buy, it's going to take a lot more to get these remodels done right. And you have that 180-day timeline. That's it in order for you to execute that. But a good QI will help you work through that. It's doable. We've watched people do improvement transactions, but it is a bit tough.
And then Bonnie has one before we go into the DSTs. The strategy more for getting rid of properties that are not in a good location or performing and transitioning to a better investment.
That's a good question. So I think what I see, I think there's three uses of this. I think one is for folks that are ambitious and want to grow their portfolio and are ready to move and take the next step in doing that, want to buy something with tremendously more value. I think that's the first type of person that goes after this. Then what we see is really two types of people on my desk. I see the second type of person is really somebody they've done this for 20, 30, 40 years and they just want to be done with active management. Right? They've tried a property management company, they've gone through that entire stuff. They've got great appreciation in their properties. They just want to go on a beach in Florida. They want to go get massages like Tracy. Like they want to hang out, right? And they just don't want to do the active management anymore. And so that's part two where this works really well. And we'll get them into some of these passive investments that I'll talk about. And then the third person I think Bonnie meets, and we have clients like this that meet exactly what you're talking about. So we had a very large real estate investor here come to us and say, look, I have a 80-20 problem. It's like 80% of my problems come from 20% of my properties. They're poorly strategically located. This is annoying. Make it stop, right? And so he still wants to be an active manager. He's just sick of exactly what you described as underperforming properties in poor locations. So he sold them. We did a 1031 exchange and stuff that made that stuff passive. And the outcome was he's like, I played a lot of golf this year. I'm like, great, that was the point, right? Like this is the entire point of what we're doing, right? Is to kind of get you out of things that are underperforming and make your portfolio better. I mean, his employees are happier now because they don't have to deal with these properties that are so problematic, right? So the short answer to your question, Bonnie, is like absolutely, right? If there's properties that are underperforming, we usually watch investors sell those first, exchange them into something that works better. We've seen that with we had clients in Florida that had underperforming Airbnbs. Dump them, dump them, just get out, right? And go and focus your time and attention somewhere else. So that's a strategy that we see as well. So absolutely, it can be used for that. It can be used for properties that are performing well and have appreciated, and you're just done. So it can be a combination of things, but yeah, we definitely see that. If 1031 exchange wasn't complicated enough for you, then here comes the 202 portion of the class, and where we spend a lot of our time on is taking people from active to passive, putting them in a passive investment vehicle. There are very few vehicles that are 1031 exchange eligible that provide true actual passivity. And so one of them is this crazy thing called a Delaware Statutory Trust. It's a silly name. It was designed by lawyers, obviously, and not marketing people. It does not roll off the tongue very easy, to say the least. But the easiest way to think about it, and I'll go to the next slide, is it's just a wrapper around real estate. It's just big, giant real estate that we can make 1031 exchange eligible. And that's really it. It's a legal entity. We can use this to, what we watch people do and companies do is purchase very large commercial buildings, apartment complexes, think 20 million or more in market value, and then offer a portion of that to investors. So you own a portion of a much larger building, but you don't get to do anything. Sponsor will do it all. So here it is on a page, right? Here's some of the advantages of doing this sort of strategy. Again, this is for when, if you're building your portfolio, it's probably not for you. And probably what happens is if you're looking like, hey, I'm looking to acquire a lot of real estate, you're probably going to be buying from the people you purchase your properties from are probably people who are probably more likely to do this next than buy another property in exchange. This might be their next move. So if you're somebody sitting here going like, I don't know if this is for me, it might be something you want to bring up to a seller and say, hey, if you don't want to sell because you have a big tax problem, I know somebody who can help you out with that. And you can use this as a strategy to help you purchase real estate. That's something to keep in the back of your mind too. So let me describe sort of what it is in sort of a quick summary. So as I said before, it is fractional ownership of a much larger real estate property, 20 million plus, 100 million, large buildings, big buildings. We usually see cash flow in day one from these investments, and that's so appealing to the investors that we have coming in. They want to know how much they're going to make. And so we'll go through an exercise with a very simple one, and we'll ask them, hey, how much money did you make off your property last year, net? Give me a number, okay? And then we'll say, okay, how much do you think your property is worth? We'll just divide those two and get a number, get a cash flow number, get a percentage. Very often what I've been finding is that percentage is pretty close to what I can get them in a passive investment vehicle. Now their brains are exploding. They're like, wait a second, I'm doing all this work on an annual basis and you can give me the exact same thing and I don't have to do anything? Yeah, that's true, right? And it becomes much more appealing to them. It's a great check to do on all of your properties as an aside, is understand what they're worth and how much you're making and how much work you're putting in. So you may have, to Bonnie's point, like you may have underperforming properties and not even know it, right? A lot of our clients don't do that work unless I've asked them to do that, right? I think that's a huge misstep. Like always know your numbers every year. Get a sense of what they are and what kind of returns you're actually making. Very important. So cash flow day one, we can exchange here. Again, this is one of the only vehicles we can use that's real estate in a 1031 exchange as passive. Plus, just like the real estate that you own directly, you get a basis step up when eventually, as all of us will, pass away and hopefully leave something to our next generation, right? You get a basis step up in the Delaware Statutory Trust too, just like your real estate. So there are tax advantages there. I'm a middleman in this transaction. There are sponsors, we call them sponsors, or syndicators, you can think of them as those types of people too, that manage these buildings and transactions. That's not for us to do. It's our job to evaluate the investment and to evaluate those syndicators if they're good or not. And so I spend my time doing that. But we have somebody experienced and experienced companies that are managing these things. And we've built some trust there. They have a track record. So we believe in that. One of the kickers here that we're trying to overcome is accreditation. So you do need to be an accredited investor to participate in this right now. There are some laws going through Congress, hopefully they can ever do anything, pass something, that would alleviate some of the accreditation requirements and require you to show knowledge instead of what your net worth is in order to define if you're accredited. I think that would be a more democratic process to do that. So we welcome some changes to the laws to do that. However, currently you got to have $1 million in net worth or make 200 to 300K if you're married on an annualized basis to participate in these. So work on that one, but that can be a little bit restricted. So that's
Brandon,
it from like a quick summary level. Go ahead.
can you walk through like a real life example of how that would work?
Which part?
Just this process that you have here, like getting into a DST. Oh, there you go.
Not that one. We'll come back to that one. Yeah, I do. We'll skip around. We'll come back. Yeah, so here's what the timeline would look like. So here's what it looks like with a 1031 exchange. I get this question a lot. They're like, oh, so I do the DST and not the 1031. It's like, no, no, no. You do the 1031, right? So it's the same process, 1031 exchange. Use the DST as your identification of property, right? So we'll put the name of the DST and the address on the sheet. That's your identification. The good thing about the DST is that we eliminate the timeline risk. So we'll watch some people say, hey, look, I really don't want to invest in a DST, but I am worried that my 1031 exchange is going to blow up because I identified 2 properties and I'm very concerned that I'm not going to close on them. What happens if that happens? Like, well, your 1031 exchange is going to blow up unless we throw a DST on there as backup. So that's a viable strategy that we'll see folks do is say, hey, look, if all else fails, at least I can still complete the exchange, right? And so the beauty of that is the 1031, the DST properties, the investments, they've already been purchased by the sponsor. They're waiting for investment, right? So we eliminate a lot of the closing risk that we have with the 1031 exchange timeline. The DST can help eliminate. So it's a great backup plan. Even if you intend never to do this, at least put it on a sheet. There's no harm or foul in doing that, right? So it eliminates that closing risk. And then ultimately we would close in the DST. If folks really want to do that, we can do it really quickly. And then the cash flow starts kicking in day one. That was your question, right, Drew?
Yep. Yeah.
Drew hasn't seen this deck, so that was not even a leading question. It's played out really
I was
well.
able to I was able to go through some of it, but not this portion. So
So that was a good one. But that's kind of how that timeline will work. It's one of the kind of underlying advantages of the DST that I think a lot of folks miss. That can just help us from a closing perspective. So here's how it works. I alluded to this a little bit, but that sponsor is going to acquire the property first. They're going to place that into a DST, and then they're looking for us as investors to really replace their capital. That's what we're doing in this sort of transaction. Sponsor is going to manage that and pay cash. They're going to make all the decisions. So that scares people in one aspect. In our aspect, they're like, thank God, because I don't want to make decisions about what happens with these properties. I want someone else to do it, right? Eventually, the sponsor will sell this property. And hopefully we're making appreciation gains on that. And then we can exchange again. So what we'll watch investors do is there's a kind of a crude terminology in this 1031 exchange space of swap till you drop. And that's literally what it means is keep exchanging until you die. Again, that sounds kind of morbid. But that's the way to do it. You can exchange forever and you don't have to pay the tax. You can defer it constantly, get to step up in basis when you pass away, and make your heirs really happy that you left them a little bit of capital. They'll be pleased with you. It's a completely viable strategy to do that. So I think we talked a little bit about why folks do the DST transaction. Your questions were great in leading into this, right? They have a significant tax bill. They want to complete a 1031 exchange. They really don't want to manage property, and they really can't find replacements. Finding replacement property is hard. Commercial transaction volume since rates went up in 2022 is down about 75%. So it's getting very difficult to find properties that you may like And it's getting very difficult to find sellers that are actually interested in selling. It's tricky, right? So here's a ready-made solution if you find yourself stuck. Couple case studies of people that we've done this with. Big investor here locally, completely done. So he had a portfolio here of 400 and I'm going to say these numbers and they're kind of crazy to think about. 440 single family duplexes in the city of Milwaukee. He managed with a management company. And some of the most difficult and challenging neighborhoods you can imagine. The amount of stress that was on this person for 20 plus years was high. It's difficult, right? And so we went through a process of over a year of disposing of this portfolio and diversifying the heck out of them. He probably owns more of these passive investments than anyone in the history of these passive investments. This man owns, which is sort of wild to kind of think about. But the best part about this is this, and why I like doing what we do. I've watched this person lose 30 pounds and get the 3 surgeries that he needed to have that he wasn't doing while he was working. That's what makes me happy. Like there's a better quality of life that he's living by doing these transactions. That's what I like, and that's what we're looking for in doing some of these things. The other case study we talked about, I actually talked about before, the 80-20 rule. So I'll skip that one, but that works too. Another happy camper. And so let me just summarize. Now I want to talk about sort of advanced, a bit more advanced strategy. So again, advantages of doing this passive action, big institutional quality properties. So a lot of stability there. We can really diversify someone. 100K minimum investments usually in these assets. So we can diversify pretty quickly. And you get the same tax treatment as you would if you're owning real estate. Your CPA will love you because this all comes in a package every year and makes their lives really easy. So they'll appreciate that. But it's the exact same tax treatment as you're getting now. Those are some of the advantages. And then why don't people do this? There are disadvantages. So there is a fee structure up front, like we got to pay people to sort of do these transactions. And so that's involved. And so it's not free to have other people manage our properties. We have to pay them. And then you do lose control. And so some people, they're control freaks. They want to have their hands on the wheel. And I don't know. Your hands are off the wheel here. So if you're not into that, it's not for you. And then obviously there's a liquidity problem too. So whenever we hold real estate, especially if there's a fee structure associated with it, we need some appreciation to overcome that. We want appreciation. We want to hold real estate. We want cash flow for us. So if you come to me and you're like, I need my money back in 3 years, say no. We need to think about liquidity up front and what that means for you and why you need it. Can't think about it in these transactions. So if liquidity is a problem, not for you either. We talked about executing, and then I wanted to talk a little bit about advanced strategies, particularly this cash out refi. Now this is like master level class stuff on the cash out refi. But if you come to this transaction with no debt on your properties, what we can do is a 1031 exchange into a DST, and we can actually refinance that property 30 days later. You can leave then 15% of your capital into that DST. The rest of it you can take out and do whatever you want with. So it's very similar to the questions we asked before about why not just refi my property, take the cash out. Well, here you can have your cake and eat it too. You can do the 1031 and then you can do the cash out and do whatever you want with that capital. So Gina asked a question previous screen. This one, Gina? Yes.
Yeah.
That's the one. Yeah, we alluded to this one. No problem. We alluded to this one with Drew a little bit on what this timeline sort of looks like with the 1031 exchange and the DST. And so it's very similar to that 1031 exchange timeline, except we're eliminating a lot of the need for the 45 and 180 days in this setup, making our life a little easier. Drew, can we send this out? I don't mind sending this out.
Yeah. I was gonna do a quick wrap up when you were finished up and just let everybody know kind of where they can get more information after this and how that's going to be sent and all of that.
Yeah,
So,
yeah.
um, I don't want to cut you off though because this is some really good stuff. So,
Yeah, so if you're feverishly taking notes, great. We can do that. But yeah, we'll send this out for sure so people can have their hands on it.
yes.
I just want to one more time on the cash out side. Again, this is really complicated, frankly. It's really tricky to execute the transaction, but it's pretty simplistic to sort of think about. So again, we can do a lot more complicated things here. We can put capital back in people's hands, and get you to a liquidity level, and get you to invest that. You put that money wherever you want them. So this is the strategy we're starting with people at this point, because we like the idea of having liquidity for you. We like the idea of deferring tax. We like the idea of telling you can do whatever you want with this money. We like that a lot, right? And so it's a really, really unique strategy that really only one sponsor is pursuing. We love it. And so you can turn around and invest in credit funds. You can turn around and invest in, if you want to invest in stocks and roll those dice, go up and go for it. And you can do whatever you want with that cash at that point. And it really solves some of the issues that folks have with control and liquidity. You can solve it with that transaction. Coming to the end, that's the process with cash out. It's pretty simple. So we really are waiting 30 days there at the end to do a refi, but it's a pretty simple process. This is where you can find me. So I encourage folks that they have, really want to get into their personal situation, don't want to talk about it on here, just reach out. We'll toss that around and figure out what makes the most sense for you. And then of course we have a podcast too, where we talk about these things in detail, and I get really geeky. So please listen to that if you want to really nerd out. That entire podcast is based on my curiosity, so we'll get pretty detailed on there about really advanced strategies. So that's where to find me. That's it really. Content. Drew, you want to
Awesome. Yeah,
you want to start singing or
right on time. No, we're gonna save that.
pick a
Remember,
song?
we're gonna wait a few more. No, I first off I want to thank you, Brandon. Just awesome, awesome information. Two, if anybody has any questions, go ahead and throw them in there now. Um, we are going to be taking this recording. We do have a place on our website that we kind of put all of our master classes. I will send an email that has a link to that in on our website. And then I will also put all of Brandon's information in that email as well to everybody. So if you guys are interested in having, like he said, a little bit more one-on-one conversation with him about specific things you have going on, um, then we'll do that too. So in the next 24 hours, you can expect all that information. Um, and then it looks like we just have one question. Susan said, can we choose the type of real estate to diversify in the DST?
Yeah, absolutely. So we see uh any type of real estate can really be in a DST. So we've seen all of it across the gamut. Right now, if I had to characterize the DSTs we've approved, there's much more of a tilt toward industrial and really hospitality. Um, Multifamily is really challenged. So we usually see a ton of Class A multifamily in this product. It's tough. I'm just not seeing the kind of cash flow there, and I don't see properties bought at a level that we feel comfortable with. We can show people that and show you what it looks like from a return perspective, but it just doesn't make us feel really good. So right now, it's a lot of hospitality, industrial, and storage. We're seeing some opportunities there from a DST side, but 100% is the answer to your question. You get to pick. We'll give you a list that we've approved, but it's you and I sitting down and walking through like which assets are you comfortable with, which ones aren't you comfortable with, right? We'll give you some indications of what we think, but we want to hear what you think as an investor.